Hello and welcome to Global Salon of Global Finance Magazine. This month, our guest speaker was Professor Viral Acharya, Professor of Economics in the Department of Finance at the Stern School of the New York University. Professor Acharya was, until last year, Deputy Governor of the Reserve Bank of India. He was our guest speaker recently, and at the end of the presentation, which will be in the next issue of Global Finance, the June issue, we ask him a few questions. The first question, Professor Acharya, is on the role of the central banks. During this crisis, the central banks have taken a new role worldwide, and we would like you to look at the role and the risks involved with the new role.
It's quite an important question in the current context, and let me just take the example of the Federal Reserve. Some of its actions have looked very much like the standard lender of last resort operations, where they are trying to essentially bring back liquidity to markets that seem to have become dysfunctional in the wake of the economic fallout and the anticipated risks from the coronavirus. However, there are also cases where the Federal Reserve is explicitly getting into the primary market of providing loans as well. Now, while there is some fiscal guarantee to these programs, nevertheless, getting into the business of originating assets is very much a quasi-fiscal activity. There could be losses here. The losses could potentially exceed the direct support that the Treasury has set aside to start with in the United States. My own view is that it is best for the central banks to avoid operations that look entirely quasi-fiscal. What is happening is that very often doing things through the central bank balance sheet becomes an expedient way of delivering large credit stimuli to the economy. Because they don't have to go through any procedures or congressional approvals, etc. Nevertheless, it's a slippery slope. These programs could fail potentially. People could ask questions, and then it could inflict blame for what are essentially quasi-fiscal programs onto the technocrats, who are not the elected leaders responsible for taking sort of taxpayer-related decisions. And so I think my sense is, to use a big term, I wonder if the Rubicon is getting crossed. And whether this could lead to questions and greater erosion of central bank independence down the line. So my sense is, even in the most desperate times, we have to follow certain, let's call it social distancing measures between the government and the central bank. I think it would be better, as my colleague and former governor of Bank of England, Mervyn King, puts it, it would be better if the central bank simply implemented the contours of the program that the Treasury had laid out, rather than actually making explicit credit extension decisions on its own.
The second question is about the SMEs, the small and medium enterprises, which are at the center of the debate in the support of the economy, for the recovery of the economy after the pandemic. And the question is, what can governments, what can local governments and states do to support the SMEs? There is a big debate about it.
My view is that the best thing would be to do direct transfers. What we are seeing is that programs that are being delivered through the banking systems are getting clogged up. They are not clear in their specifications when they are laid out, such as the Paycheck Protection Program in the United States, because the program is being designed on the fly. Banks are not sure about the exact guidelines. The borrowers are not sure about the exact guidelines. There could be exposed scrutiny by the audits and the budgeting office as to whether the programs were delivered right or not. But I think what is key right now is the speed and the efficiency of transfers. So my sense is that something where you essentially link a direct transfer to a small business that is tied to its past tax payments. So it respects the principle of proportionality. Those who are bigger, have more operations, would get more relief. They have to be in the tax net. If you have been evading taxes, then sorry, in a way, you don't get the taxpayer money to do the support. There would still be unemployment insurance support for those who are forced to leave these firms in some cases. And I would go a step further and say that it would be better, in my view, not to tie the transfers to specific purposes. I think let the firms decide which is the bigger binding constraint for them. Is it your financial payment? So a restaurant in New York might have a very high rental expense compared to in other places where perhaps the manpower is the bigger cost of the overall budget. Let the firms decide where they want to optimize the allocation of the transfer. If the employee jobs are lost, support them through unemployment insurance on the side. I think this has the highest chance of succeeding for efficiency of delivery to the last mile.
And finally, we would like to know what you think are the specific risks and limitations that emerging markets have in dealing with the current crisis.
I think I would say the first and foremost, the emerging markets are getting hit by what one might call as a debt sustainability questions. They have a large endowment shock simply because of the nature of the virus outbreak, the containment and the mitigation strategies it requires. There is an economic slowdown or shutdown, depending on the stringency of the measures that have to be adopted. And if there is a virus outbreak in the specific country we are discussing, there would also be needs for medical expenditures, testing, the PPE for the medical staff, and down the line testing, tracing, and isolation, quarantining expenditures. So the first and foremost, emerging markets, by not having the virtue of being safe havens in the sense of having per capita GDP, the quality of institutions, and the development of their markets, that would mean that their borrowing costs don't go down in such times. They, if anything, they rise. And I think this creates, this makes it, they are really caught in some sense between a rock and a hard place, which is the shock is like any other country, but their capacity to spend is much, much more limited than it is for the advanced economies. So unfortunately, this means that we might have to seriously think about debt relief, especially for the very poor emerging markets, through the multilateral agency. And what some of my research with Professor Raghuram Rajan at University of Chicago and our student Jack Shim at NYU suggests is that targeted relief might be the best outcome, which is that you give a debt relief, you ensure that the default costs are avoided, you ensure that the country retains access to the debt markets down the line, because you are not because relief would mean that it's not a technical default. But the aid needs to be, the relief needs to be targeted. It needs to be channeled perhaps to two important purposes. One, I would say, is the medical expenditures, and two would be fiscal transfers to the most in need. I think the displaced workers, in case of some countries, migrant laborers, in case of some others, this could mean really the poorest and the weakest sections of the society, where not being able to step out to do their daily jobs would essentially mean a loss of livelihood, and with very dramatic humanitarian consequences. So targeted relief for emerging markets is what I would recommend at this point. It would require multilateral agencies such as the IMF and the World Bank to be